This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Solid sales. General Motors, Ford, and Chrysler all report double-digit sales gains for October. So what's going right for the big three and what the industry needs to keep firing on all cylinders?
Buyback bonanza. Companies have loads of cash on hand, and many are using it to buy back their own shares. Are buyback companies a better investment than ones that don't?
Picture perfect? Kodak is back. The company's next chapter started today. Shares began trading on the big board, but this is not your father's Kodak or the one you used to know. Can it succeed? All that and more tonight on Nightly Business Report for Friday, November 1st.
Good evening, everyone. Americans are buying cars, a lot of them, and showrooms across the country were bustling in October. Despite the government shutdown, October was another month of strong auto sales, proof that the manufacture and sale of new cars and trucks are one of the engines powering the U.S. economic recovery. Now, each of Detroit's big three scored double-digit sales gains, and much of that on pickup trucks. General Motors was in the fast lane. Sales surged almost 16%. At Ford, sales grew 14%, and at Chrysler, they were up 11%. Phil LeBeau joins us now from Chicago with more on all of that. So it was an amazing month, Phil. The headline numbers look fantastic, but when you look under the hood, there are some numbers that weren't so good, like the Chevy Volt numbers. They dropped. What happened there?
That got a lot of attention today, Susie. The Volt sales dropped 31.7% for the month of October this year compared to October of 2012. Now, GM is quick to point out that October of 2012 was the second best month ever for Volt sales, and they believe that the inventory is a little bit on the low side, so as a result, it's not as though they're seeing falling demand, but at the same time, the Volt sales this year are just over 18,000. For the year, Volt sales are up just 2.7%. So not a huge amount of growth there. And a lot of people are sitting there saying, will this be a niche vehicle? Or can General Motors really take these sales and grow them at a nice clip over the years to come? And that remains a big question for a lot of people watching this.
Tell us about pickup truck sales, Phil. Have they started to slow a little bit?
They are, and that's expected for the most part in the industry. They had a huge run in the first half of this year, Tyler, largely because of what we saw with the housing market picking up, small business owners restocking their fleets, and almost everybody in Detroit will tell you that they expected a start of a cool down in terms of pickup truck sales. That doesn't mean a slowdown, just that they're not going to grow as quickly as they were in the first half of this year.
Phil, I was surprised to see that incentives and rebates are back. What's the story there? And is this going to keep the auto sales market strong going into 2014?
Well, Susie, this is what worries people the most about the auto market. Will they start to repeat the mistakes that they made several years ago when they really started putting huge amounts of money on the hood of the vehicles in order to juice the sales? We're not seeing that yet. What we are seeing is a little bit more competitive market between the automakers, and the concern is if this economy plateaus or doesn't continue growing at the clip it's been growing at, will they have to put more money out there in order to goose the sales? All
right, we'll keep watching. Phil, thanks so much. Phil LeBeau reporting from Chicago.
Well, it is a new month, and on Wall Street, day one was a good one for stocks. The market's got a big boost from a surprisingly strong read on U.S. manufacturing in October. It rose at the fastest pace in 2.5 years. Also, a strong read on factory activity in China. All the major averages avoiding a third consecutive day of losses, with stocks rising into the close. The Dow up nearly 70 points. NASDAQ added 2. The S&P 500 was up 5. Rates on the 10-year Treasury note, well, they rose steadily all session long, closed up at 2.6%.
A top Federal Reserve official said today it's time for the central bank to phase out its stimulus program. Charles Plosser, president of the Philadelphia Federal Reserve Bank, said the Fed should have begun tapering back at its meeting earlier this week.
I thought we kind of missed an opportunity to make a small gesture to begin signaling that, in fact, this is a dial we can move and we can adjust it and fine-tune it, if you will.
Plusser also suggested setting a maximum dollar amount for the Fed's bond buying program instead of sticking to the target of the U.S. unemployment rate getting down to 6.5%.
And in addition to the Fed's stimulus this year, one of the factors that has helped stock prices in 2013 is a rash of buybacks. Companies using their cash reserves to snap up their own shares. That reduces the supply of stock and lifts the profit per share. Dominic Chu has the story.
Corporate profits and the stock market are at record highs, but one measure of a company's financial success may be a bit more complicated to explain. That's earnings per share.
If you have $100 in profits and 100 shares outstanding, but you buy back half of them, your earnings per share will go to $2. So you can double your earnings per share, a key stock market measure, without actually growing your profits. It's one way to grow earnings per share. It is not a way to grow corporate profits.
Miller Tabak's chief economic strategist, Andrew Wilkinson, took a look at a handful of companies with larger share buyback programs to look at how earnings per share were affected. Take business software giant Oracle. Wilkinson estimates that its earnings per share were about 9% better this past quarter simply because of having fewer shares outstanding. Global casino giant Wynn Resorts got an estimated 23% improvement. And satellite TV provider DirecTV got an estimated 47% improvement. Nuveen Asset Management's chief equity strategist Bob Dahl said the effects of share buybacks are important.
Most estimates say that 2 to 3% of the earnings growth we've seen is from buybacks, the shrinkage of shares, so it's not inconsequential.
Generally speaking, companies that buy back their own shares have outperformed the broader market. Since the end of 1999, Wilkinson notes that the S&P 500 buyback index is up 250%. That's versus the 20% rise in the S&P 500. There's even an exchange-traded fund that tracks companies that engage in bigger stock buyback programs. The PowerShares Buyback Achievers, ticker PKW. So that's one place to look if you believe or don't believe the stock buyback story. For Nightly Business Report, I'm Dominic Chu.
Tim Courtney is a believer in stock buybacks. He's Chief Investment Officer at Essential Wealth Advisors. Tim, welcome to Nightly Business Report. Let me begin by just asking you, sort of get into the debate about stock buybacks. You know, some people would say a stock buyback is basically you're playing with the numbers. It's financial engineering, and that it would be better if a company used that money to grow the business, to develop new products. What do you say to that?
Well, I think, for one, I think the market is pretty good at seeing through that. It is pretty transparent, and it's hard to hide the fact that you are increasing earnings per share by doing share buybacks. So I think the market does a pretty good job of pricing the stocks and seeing through that. But I think another reason why companies would do that, besides maybe trying to make the numbers look better, is because maybe they don't feel like they have enough confidence in the economy, or maybe there are legislative risks to go take cash and go do a large-scale research and development project. They'd be better off taking that cash and going and buying back stock.
You know, you saw some of the numbers that were in Dominic's piece there. If I'm trying to choose between two companies relatively comparable in many ways, and one is buying back its shares, the other is not, should I choose the one that's buying back its shares?
Well, I think it depends, although that's a good sign. If the company is looking at its prospects and has excess cash and is putting that cash to work back into buying stock, I think that's a mark in its favor. All of the things being equal, you would want to see that, certainly.
But not all buybacks are beneficial. It doesn't always work out that way, right?
That's right. I mean, there are some studies that show that companies that have lower profitability, when they do invest in themselves, they tend to have lower returns. And there are some examples of some stocks recently that have shown that same phenomenon. So it tends to be the companies that it works best for are companies with higher profitability, where they're taking free cash and putting that to work, buying back their shares. Not so good for companies who are struggling with profitability.
Do any of those companies that you just mentioned, did any come to mind? Name them.
Well, there was an article yesterday from the Wall Street Journal talking about IBM and how IBM's price really has not moved in the last couple of years, and primarily it's because IBM is having some trouble generating revenue growth. So I think that's a good example of a company that's doing share buybacks, but it's not affecting the price. And again, that goes back to the market being pretty effective at determining what's causing these earnings per share increases and not just adding value onto the stock because they're buying back shares.
So, Tim, what is the trend now for buybacks? This year was a big year for buybacks. It seemed like every company was announcing some kind of buyback program. Has the trend run its course?
It looks like it's going to continue because earnings are still growing. Companies, it looks like in the third quarter, profits will set a new quarterly record. And so there's going to be a lot of cash on the company's balance sheets, and that is probably going to tend to indicate that these buybacks will continue and probably into 2014 increase.
Let me throw a little curveball at you. Some companies, like Apple, are being urged to go out and borrow money to do a stock buyback, not to use their cash, in Apple's case, because they have to bring it back from overseas and pay tax on it. Does that tell you anything, if they're borrowing to buy it? Yeah, I've seen that a lot, and I think the math shows that can make sense, and I think, again, that's an issue with the tax code. I don't necessarily agree with some of the tax policies that we have for repatriating of cash, but with those tax costs of bringing the money back into the United States, it certainly can make sense to borrow and buy back.
All right, well, we're going to leave it there. Thank you so much for all your thoughts. Tim Courtney, Chief Investment Officer at Exensio Wealth Advisors. And some more trouble at J.P. Morgan Chase. The U.S. Justice Department and the Securities and Exchange Commission are now looking into the hiring practices of J.P. Morgan at its Hong Kong offices, amid reports that relatives of Chinese party officials got jobs there. The bank also said in a regulatory filing that several U.S. government agencies requested information about its foreign exchange trading business and whether its employees were rigging currency markets. And J.P. Morgan Chase isn't alone. Citigroup, the U.S. bank that conducts the most international business, also revealed that federal investigators are looking into its foreign exchange trading for evidence of possible market manipulation. And more now on the troubled rollout of the Affordable Care Act's online marketplace, Healthcare.gov. A company called CompuWare took an independent look at what users of the website experience as they shop for health insurance plans. And what they found may surprise you. Bertha Coombs has more.
How bad was the first day of open enrollment on Healthcare.gov? Just 6 people managed to enroll in the first 24 hours, according to newly released Health Department documents. By the morning of October 3rd, fewer than 250 because of the technology problems plaguing the site. While access was universally poor, the site's glitches appear to have made access in some of the 36 states on the Federal Insurance Exchange worse than in others.
There are variations that tend to be affected by geography or which internet service provider you're using or even which browser that you're using.
Engineers at CompuWare in Lexington, Massachusetts began independently tracking Healthcare.gov end-user experience in mid-October. At that time, users in a handful of states like Oklahoma, in green, saw pages load with normal 1 to 2 second performance. But for most, in red, it was taking well over 8 seconds.
Those tend to be factors that relate to geography because different service providers exist in different geographies. There are certain techniques that can be employed to minimize these kinds of differences.
Recent fixes appear to have improved user experience times overall.
You want to provide a performance testing environment or at scale, so millions of users are simulated users are running against your site to make sure that it will scale and provide the response times necessary under that condition.
Jeff Zients, the Obama advisor overseeing the tech surge to fix Healthcare.gov, says their measurements are now showing that page loads are taking less than 1 second on average across the site. But here at CompuWare's end-user testing, they are still seeing wide disparities. In Kansas City, Kansas today, it was pretty good, about 4 seconds. But still, next door in Kansas City, Missouri, it was taking over 30 seconds. To improve your own experience, CompuServe suggests making sure you have the latest version of your web browser, clearing your cache history of old Healthcare.gov cookies, and optimizing your connection by making sure you're not slowed down by sharing Wi-Fi, for example. Health officials vow the site will work smoothly by the end of this month.
Well, they'll see a surge of activity that they better plan for.
Because the stakes are far too high now for another failure. Bertha Coombs, Nightly Business Report, Lexington, Massachusetts.
Still ahead on Nightly Business Report, a Kodak moment. The iconic American brand is back on the big board. But how does the new company differ from the old, and is it a good investment? Who says you can't go home again? Well, Kodak has emerged from bankruptcy and began trading again today on the New York Stock Exchange. But as Hampton Pearson reports, the pioneering photography company is vastly different from your great-grandfather's Kodak.
The new Kodak pictures itself as a technology company focused on imaging for business with a full line of high-tech commercial printing products. Now trading on the NYSE with its new ticker symbol, KODK, today was the first Kodak moment for the new business, according to CEO Antonio Perez. Quote, "The change in our symbol reflects that we're a new company that's focused on business-to-business products and services, well-capitalized, and firmly committed to delivering value to our shareholders and innovation to our customers." Eastman Kodak, the Rochester company founded in 1889, became an American icon, selling cameras, film, chemicals, and photographic paper. But those products became almost useless in the digital age. Kodak did not transition fast enough and was forced into a bankruptcy filing last year. A textbook case among leading economists for how not to survive in the 21st century global economy. Mistakes of the past still haunt the new company. Leading Wall Street analysts are adapting a wait-and-see attitude. Standard & Poor's gives the company a borderline junk credit rating. The risk comes from Kodak's small share in the large, mature, and declining market for commercial printers. Kodak Professional Film, however, remains the gold standard for much of the motion picture industry, including new contracts with 6 major Hollywood studios just in the last year. Any future Kodak moments will depend on how the company competes in an industry that has been totally transformed by technology. For Nightly Business Report, I'm Hampton Pearson.
Well, the Container Store also began trading on the New York Stock Exchange today, and that's where we begin tonight's market focus. Shares of the retailer doubled after pricing its shares above the expected range. The CEO of the company, which specializes in shelving, storage bins, and boxes, says he's optimistic about the growth prospects.
We've indicated that we can grow absolutely at 10% square footage growth per year minimum, and we've spent much of our history doing that, so we're looking at double-digit growth from here on. It's great to be immature in retail with only 63 stores. There's a lot of runway left.
And the stock surged 101% today to $36.20. Weakness in refining led to a decline in Chevron's quarterly net. The country's .2 oil company reported gas and oil output increased, but not enough to meet estimates. That pressured the stock. It closed down almost 2% to $118.01.
A boost in media and sports revenue helped Madison Square Garden post an earnings beat. The operator of the New York sports arena said net income jumped 16%. That made up for weak revenue generated by Radio City Music Hall. But shares ended the day down at $58.45, a drop of almost 3.5%. And shares of First Solar surged after the company boosted its profit forecast for the year. The maker of solar equipment reported earnings yesterday that came in way ahead of analyst estimates. Sales in Canada and revenue from a solar plant in California helped the company beat forecasts. The stock climbed to a 2-year high, up today almost 18% to $59.14.
And our market monitor guest this week says the stock market should continue to rally this month and in December. He's calling for the Dow to hit 16,000 by the end of the year and 1,800 on the S&P 500. He's Hank Smith, Chief Investment Officer at Haverford Investments. Mr. Smith, welcome. Good to see you here. How confident are you that the markets will continue to do well?
Well, we're entering a very seasonally favorable period of time. November and December historically have been very good months for the market. We've gotten over a historically unfavorable seasonal period, October and September, in fact, making new highs along the way. But look, what's happening now is confidence and sentiment is improving from years of fear and anxiety, and I think we have a long way to go in that regard.
Yeah, but Hank, what's really going to drive stocks to go that much higher from here?
Well, first of all, fundamentals have been good and continue to be good. Corporate America is the shining star from the recession and financial crisis. Balance sheets are exceptionally strong, flush with cash. Productivity is high. Earnings are good. They continue to beat expectations. And if we can get an economy that picks up a little bit, in 2014, I think that's going to fall right to the bottom line with continued good earnings.
Let's move, Hank, to a couple of your stock picks, and let's begin with J.P. Morgan, a bank that has really been operating under a regulatory and legal cloud, continues to do so. Why should I put money into that bank, given its circumstances, and not another?
Right. It's still one of the best managed and highest quality banks in the world, and with tremendous earnings power. And it's amazing how after discussions of $13 billion, $15 billion, the stock is still holding up. That's because investors realize the earnings power this company has. And I think you're getting it at a very attractive valuation right now.
Let's talk a little bit about IBM. You heard our guest earlier in the program saying that despite all of these stock buybacks that it's been doing, that the stock hasn't really benefited from it. And if you look at the chart, here's a stock that was above 200 not too long ago and now at 179. Right. Why do you like it?
Well, look, IBM is about software and services. That's how the company has evolved, and yet the quarterly misses in the past 2-3 quarters have been about the hardware business, which is becoming sequentially less and less important. We think they're going to get through those problems, and we do believe they're going to hit that $20 per share by 2015, which makes this an extraordinarily cheap company. And if you're worried about the market reaching all-time highs, this is a nice stock to buy that is a very high-quality company that's not at its all-time high.
Give me a 30-second pitch for your third stock, United Health.
Well, it's the highest quality of the HMO group. And look, the HMOs are part of the solution. They aren't going to be excluded. That was a fear from last year. And we're very encouraged that the government's hiring their Optum division to fix the software glitches of government.org. And we think this company, too, is very attractively priced with very good growth prospects.
All right, Hank, do you or Haverford own any of these stocks?
We do. The Haverford owns them, and I own them personally along with my immediate family.
Putting your money where your mouth is. Thanks very much, Hank. Appreciate it. Hank Smith, Chief Investment Officer at Haverford Investments. You too. And still ahead, the cost of protecting the world's largest single-day spectator sporting event. That's the New York City Marathon. A gunman shot and killed a TSA worker inside a terminal at Los Angeles International Airport this morning. That delayed flights into and out of LAX for hours. The shooter, a 23-year-old from New Jersey, was taken into custody. Several others were injured.
That deadly shooting at LAX comes just 2 days before the New York City Marathon. Now, security was already high in the wake of the terrorist attack at the Boston Marathon earlier this year. Mary Thompson takes a look behind the scenes of the world's largest marathon and what it means for the New York economy.
When runners toe the starting line of Sunday's New York City Marathon, they do so in the long and tragic shadow of the Boston Marathon bombings.
In light of the attacks in Boston this past April, the NYPD began examining and enhancing its coverage of the race, starting the day after the Boston Marathon.
The New York Roadrunners Club is spending over $1 million on security this year, more than double spent on the last marathon. On race day, spectators' backpacks will be subject to search. Hundreds of mobile cameras around the city will be monitored by security. 48,000 runners will be screened at the start and stripped of certain gear.
But some of the things that we changed that was new this year was the over-the-shoulder hydration packs that some of the runners wear. They're camelbacks or what they're called in the industry. Those are not going to be permitted this year.
This is a comeback year for the marathon. Canceled at the last minute because of Superstorm Sandy, officials were criticized in 2012 for not acting earlier. But the bad feelings didn't last. Race director Mary Wittenberg saying that last year's controversy didn't scare runners or sponsors away.
Sponsorship is up. We're going to celebrate ING this year, and we've just struck the premier partnership, title sponsorship for the marathon for next year, for the next 8 years. So partnership is stronger than ever.
Case in point, the maker of running gear, ASICS, which never thought of dropping out.
We've been with New York over 20 years, 45,000 runners, 2 million spectators. This is the largest race in the United States. So we're excited, and it's something that we've been doing for a long time, and we love it.
Like the runners, they are in it for the long haul, staying the 26.2-mile course come hell or high water. For Nightly Business Report, I'm Mary Thompson.
And to read more about preparing for the New York City Marathon, head to our website, nbr.com. You know, it's so nice to see people so positive, whether you're a sponsor or a runner, and against all odds.
Yeah, that's right.
And out there to
so
run.
many people. I was talking to one who was running on this weekend. She said she has to get there like 4 hours early, in part to comply with the new security screenings for the runners themselves.
It's going to be a great day for the marathon.
It's going to be cold, but good.
That's Nightly Business Report for tonight. I'm Susie Garib. Have a great weekend.
And I'm Tyler Matheson. Thanks for joining us. Have a great weekend, everybody. We will see you back here on Monday.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garib with the Nightly Business Report News Brief. Americans bought a lot of new cars in October despite the government shutdown. Detroit's big three automakers scored double-digit sales gains, and much of that on pickup trucks. Wall Street kicked off November with stocks in the green, getting a big boost from a strong read on U.S. manufacturing in October, which rose at the fastest pace in 2.5 years. The Dow rose nearly 70 points, the Nasdaq added 2, and the S&P was up 5 points. Kodak has emerged from bankruptcy and began trading again on the New York Stock Exchange. Shares rose 1%. The legendary company is now focusing on commercial printing. And shares of the Container Store doubled in price on their very first day of trading on the big board. Be sure to tune into Nightly Business Report right here on your public television station.